I'll start with you. I mean, obviously, the president's comments come into this very thriving debate about whether we're on the precipice of a recession. Obviously, the bond market is throwing hints in that direction, but the current data in the USA, probably not yet.
That's right.
Where do you come down?
Well, I mean, if you look at the economic data, I think the near-term odds of recession are quite low. Remember, when you start to look 6, 9, 12 months out, it gets more difficult the further out you go. But, typically you don't see new home sales rising 15% a year before a recession. You don't see, refinancing activity surging before a recession. A classic recession indicator, in my view, at least in terms of the bread and butter economic data, is looking at aggregate weekly payroll. So that's basically the sum product of jobs, hours, and earnings against headline inflation. And we know that headline inflation is slowing, basically below 2% all year. And the aggregate income series is running about 4.5%. So that means a reasonable baseline for consumer spending over the next year is around 2.5%. And that's even before you're talking about the increased cash flow from refinancing and the fact that the savings rate's quite elevated. So, and as I mentioned, the housing market's picking up, and that's going to provide some follow-through into construction activity. I mean, I remember talking with Sarah a few minutes ago about CapEx. As a point of fact, because we deal in the fact world here, core capital goods orders are up about 6.5% annualized so far this year. Now, the data's through June, but this sort of CapEx is falling off of a cliff. I mean, it's
what the Fed chairman is telling. It's one of his reasons for why he's
saying
now
that could happen. He's saying that could happen. But you want to talk about aggregate investment, you have to look at something more than just equipment and Boeing orders, Sarah. I mean, inventories are quite lean. I mean, we had pretty strong private domestic demand in the second quarter. So, as I mentioned, I mean, if you look at classic sort of leading type indicators that we look at, just forget the bond market for one moment. It doesn't really point to a recession imminent, at least this year.
Right. So we got to get another side in here. Peter Boockvar joins us to push back on all of that, including our makeup chair CapEx debate. Peter.
Well, since World War II, about 60% of the recession's consumer spending was still positive. So you don't need a decline in that in order to have one. I mean, we can argue that the manufacturing side, the trade side is already in or around a recession, certainly globally and possibly in the U.S. So then that begs the question of, okay, what does the consumer do from here? But this is an evolving situation. You look at the July payroll number in manufacturing, hours worked fell. So that's the first sign that employers are responding to the slowdown by limiting worker hours. So now we're beginning to see that spilling over into the services side. The ISM Services Index is at a 3-year low. Take transportation, for example. Transportation is slowing because manufacturers are making less goods. So that's the first sign that it's beginning to show up on the services side. So where this goes from here on the services side in terms of hiring, hours worked, we're going to have to see. But I'm confident that if these tariffs don't come off, if on December 15th we do get all of Chinese imports being tariffed at the full rate, then that will tip us over into recession. And one last thing, I always argue that in this asset price dependent economy that we're in, where the stock market goes from here could be the deciding factor of when we go into recession. Because after the fourth quarter sell-off in stocks, retail sales in the first quarter was pretty punk. So if you get a sharp decline in the stock market, that will tip over the consumer, and that will send us into recession if the stock market does then not immediately have this rebound. And one more thing, I don't expect the Fed rate cuts to help us in any way to cushion the blow from weakness overseas and tariff-led weakness in manufacturing.
Steve, there's a lot of room between the economy's firing on all cylinders, everything's working great, we're perfectly in gear, and we're in a recession.
Right.
A 2% economy, which seems like what we've had for a while right now. The market's trying to figure out which way it tips from here.
Right.
What do you think?
So to take both sides of this, it sounded like the consumer is in good shape. Sounded like the home sector or housing sector is ramping back up again. And to Peter's point, you can have a manufacturing or an industrial recession, and the consumer can still be okay.
Which we had in 2015 and 16,
so
more or less.
If the consumer is still okay, here's the problem. You can have a recession. You're always going to be leading into a recession because when you just come out of a recession, you're leading into another recession. But most of the stock market's gains, or 10% of them, can be before the recession actually takes place. So if the consumer is okay, employment data or unemployment data is tame, you probably stay invested.
In the market.
In the market. Now, you can have the volatility that we've seen. You can see, to Peter's point also, that the market can be pushing back and forth. But that is on trade. That is on the rates discussion. And I agree with the president. If the trade discussion wasn't on the forefront, the market would be dramatically higher.
He said 10,000 points.
Well, the president likes to throw out points, and a lot of us talking heads like to throw out points. And if we fact check all of us, we're probably all wrong at a certain amount of time. I don't know how many, and you can't prove the counterfactual either way. It doesn't matter.